All right, let's talk about crypto. These ETFs, they seem like the simplest way to get in on the action. But what are you really buying when you click that button? Today, we're going to pop the hood on a crypto futures ETF and find out what's actually inside.
So let me just ask you this straight up. You buy an ETF that's supposed to track Ether. So do you own any Ether? It seems like a no-brainer, right? Well, the answer is probably not what you think. And honestly, it's something every investor really needs to understand. The appeal of these things is huge. You don't have to worry about complicated crypto wallets, you're not going to lose your private keys, and you don't have to sign up for some new exchange. You just log into your normal brokerage account and buy it just like you'd buy a share of stock. It feels like the most direct route into the crypto market. And this is exactly what most people think. I mean, the name says Ether ETF, so you just assume you're getting, Ether. It makes perfect sense. But the reality is a little more complicated than that.
Okay, so let's really dive into this. To figure out what's going on, you can't just read the name on the tin. You have to go straight to the source, which is the fund's own financial statements. That's where they have to show you exactly what they own.
And right away, here's the big reveal. When you buy this Ether ETF, you are not buying a fund that holds any actual Ether, not one bit. The fund gets its exposure to the price of Ether in a totally different way. Take a look. This is what the fund actually holds. You can scan down that list, and you won't see Ether anywhere. What you do see is this: 414 CME Ether futures contracts. So the big question is, what on earth is a futures contract?
So, in plain English, a futures contract isn't the asset itself. It's more like a bet on what the price of that asset will be in the future. The fund is basically making an agreement to buy Ether at a set price on a specific date. It's what's called a derivative. Its value is derived from the asset, in this case, Ether.
And this brings us to a whole new layer of complexity. See, those futures contracts, they don't last forever. They have an expiration date. You see it right there, June 27, 2025. You can think of that date as a ticking clock, and it introduces a very unique kind of risk. So because the fund wants to stay invested and track Ether's price, it can't just let these contracts expire. Instead, it has to do this little maneuver called rolling. Right before a contract is about to expire, the fund sells it and then immediately buys a new one that expires later. This happens over and over and over again. Now, here's where the risk comes in with that rolling process. Sometimes the new contract is cheaper, and that's great, but pretty often a situation called contango happens. That's just a fancy word for when future contracts are more expensive than the current one. This puts the fund in a tough spot, forcing it to constantly sell cheaper contracts and buy more expensive ones. And that sell low, buy high cycle can act like a slow leak, a constant drag on the fund's performance. On top of that, hidden costs from rolling, there are also the costs you can see right up front. I mean, managing a complicated portfolio of futures contracts isn't free, right? And that cost gets passed right on to you, the investor, as an annual fee. And here it is, pulled right from the fund's documents. The price tag is an annual operating expense of 0.95%. So what does that mean? Well, for every $10,000 you invest, you're paying $95 a year every single year, whether the fund makes you money or loses it. So even with all this financial engineering going on, you've got the futures, the rolling, the fees, we can't forget what this ETF is actually tracking. At the end of the day, its value is tied to the price of crypto, which of course brings us to the good old topic of volatility. I mean, just look at these one-year returns. It is a wild, wild ride. A regular Bitcoin ETF is up almost 45%, but the Ether ETF we've been looking at is down almost 37%. A fund that was betting against Bitcoin lost 45%, and a leveraged fund was up over 50%. The swings are they're absolutely massive, and they're completely unpredictable. And that, of course, leads to the warning you'll find buried in the fine print of every single one of these products. It's a standard warning, but it's one you have to take seriously. The insane volatility means that losing a lot of money, even all of your money, is a very real possibility. So let's put this all together. The simple, easy-to-buy wrapper of an ETF can hide a ton of complexity underneath. Yeah, it makes crypto more accessible, for sure, but that accessibility doesn't get rid of the risks. It just kind of changes what they look like. So let's just quickly recap the big takeaways here. First, with this kind of ETF, you're buying futures contracts, not the actual crypto. Second, that rolling process can create a hidden drag on your returns. Third, you've got that annual fee to think about. And last but not least, no matter how it's structured, you are still strapped in for crypto's extreme volatility.
And that leaves us with one final thought. And this one goes way beyond just crypto ETFs. When you buy any investment, are you just buying the name on the label? Or are you buying the specific bundle of assets and risks and costs that are all packaged up inside? Because as we've seen today, the difference between those two things, well, it can be everything.